Hello guys, this is my second video on the gas and oil industry, and today I plan to analyze two companies. The first company is ATO, the second company is MPC. I'll be analyzing their financial statement and providing you with my opinion, an opinion which you may take into consideration. I'd like to begin this video by discussing the two companies' respective share price and their respective earnings. From Yahoo Finance, we can see that ATO has beaten all four of its quarterly earnings last year, and the estimate for its first quarterly earning this year is greater than the estimate for its first quarterly earning last year. In terms of the share price, at the beginning of the pandemic, the company was at 117 and it reached a peak of 121. So the share price did not increase significantly. MPC, we can see that MPC bet all four of its quarterly earnings last year. And here again, the estimate for its first quarterly earning is greater than the estimate for its first quarterly earning last year. In terms of the share price, the company started off at 54 and it reached a peak of 87. Now, let us move on to their financial statements. The first financial statement belongs to ATO, and from their financial statement we can see that the company increased its revenue from 2,745,000,000 to 3,241,000,000. Subsequently, the company experienced a rise in income from 511 million to 665 million. The first thing I'd like to take note of is the current assets and the current liabilities. As we can see from their financial statement that current assets are smaller than the company's current liabilities. This is not a good indication, and we'd like to see more current assets than current liabilities. Hopefully in the future the company will manage to reduce their current liabilities and increase their current assets. This would improve the ratio between them, and it would also increase the company's equity. The company could sell their non-current assets and then use the cash to reduce current liabilities. Or they could use the cash they're receiving from their financial activity in order to reduce current liabilities. From their financial activity, we can see that the company is selling their shares, and they're selling a lot of their shares. In 2019, financial activity was at positive 725 million, and it rose to a positive 3,143 million. They're taking their cash back by selling their shares, and it indicates to me that the company is not in a good financial situation. It seems to me that the management is trying to save the company by selling their shares, by reducing the share price of their shares. And from their financial statement, it seems like this activity is not working out for them. I'd like to also point out their operating activity. We can see that in 2021, their operating activity was at negative 1,084 million. This was likely caused by Winter Storm Uri. However, even if we don't take into account 2021, their financial statement does not look good, and I would not advise investment into this company. The next thing I'd like to discuss is MPC's financial statement. Now, from their financial statement, we can see that MPC increased its revenue from 51,808 million to 120,930 million in 2022. Subsequently, the company experienced a rise in income. In 2020, income was at 3,255 million, and it rose to 11 billion in 2022. A concern in their financial statement is their equity. The company's equity during this time period decreased drastically. In 2020, it was at 42,139 million, and it fell to 32,616 million. Now, this fall in equity is explained by the change in non-current assets for this company. In 2020, the company's non-current assets were at 78 billion, and in 2022, non-current assets fell to around 55 billion. This is a drastic fall in non-current assets. The company is selling their PPE. This explains why equity fell. And it's a concern to me because the company is reducing their influence in the market, their potential future profitability. And I'd like to see an increase in non-current assets in the future. The fact that the company is selling their non-current assets explains why investment activity went from negative 6,261 million in 2020 to 14 billion to a positive 14,797 million in 2022. Again, this is a concern. The company is not investing, they're reducing their influence in their respective market, and therefore they're reducing their profitability. And we as investors would like to see the company expand their influence, expand their production, and therefore their future profitability. Hopefully, the company will stop selling their non-current assets and increase their investment activity. The next concern I have with this company is their financial activity. Their financial activity rose drastically in 2020. Their financial activity was at negative 3,376 million, and it rose to negative 14,419 million. Now, this increase indicates to me that the company is likely buying their shares. Therefore, it may lead to an increase in share price, but the increase may not be significant. The company is spending too much money on their shareholders, over gratifying their shareholders. And I'd like to see a fall in their financial activity, a reduction in their financial activity in the future. Perhaps they could use the money to improve their financial statements, use the money to invest, or to reduce their liabilities so that their equity improves. That is all I have to say about the company. Let us now rate both companies. I'm going to place Atmos Energy in the trash section. The company's current liabilities are too high. They need to reduce their current liabilities and increase their current assets. But most importantly, I would like to see a change in the company's financial activity. I'd like to see the company I want the company to stop selling their shares and potentially even start buying back their shares. If the company does that, then I may place them in the careful section, but for now, they're staying in the trash section. MPC is going to be placed in the careful section. The company needs to stop selling their non-current assets. I'd like to see their company invest more into their market, improve their profitability, and most importantly, the company needs to reduce their financial activity. They're over gratifying their shareholders. They could use the cash to improve their financial statement. For example, they could use the cash to reduce their current liabilities, and that would improve their equity. If the company does all of this, then they may get a better rating. But for now, they stay in the careful section. In any case, this is all I have to say about the two companies. In the next video, I plan to cover Hess and Kinder Morgan Corporation. Hopefully you enjoyed this video. If you did, give it a like and subscribe. And see you in the next video.